Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high net worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
Hi, welcome to Long Story Short with Adam and Andy. You know, Adam, I'm sitting here in Reston, Virginia. It's a suburb of Washington, D.C. I can literally look out the office window here and see the D.C. Metro as it goes all the way out to Dulles Airport. And living here, I always wonder, we hear this news about the government shutdown, and it's a big deal locally because quite a lot of people who either work for the government or work for independent contractors who support the government. So basically no one's working right now, which means my commute is easy. But I'm always curious about this though, because outside of maybe the financial news media and the local media here outside of DC, I wonder, is this that big of a deal across the rest of the country? I mean, you used to live here, now you live somewhere else. But what do you think?
No, not really. Nothing noticeable other than we're flying on Wednesday night and everyone's telling me how TSA agents are trying to work while not getting paid, which seems really hard to do. But I personally hope they're paying the same amount of attention to luggage coming through the scanners, which I know they
I
are.
would certainly hope so. I feel like there's always these words that we have to read up on and re-educate ourselves on. Things like, stagflation every now and then. Furlough is another one of those. We're you only talk about furloughs, during these government shutdowns.
Yeah. I really feel for the people that work for the government because it seems like many, many times every year we have this conversation, usually revolving around fights with the debt ceiling that the government's going to shut down. And I was actually looking back when we did a little market research on this, just thinking about when the last time the government actually shut down. And I thought it wasn't that long ago, but apparently it was. It was December 2018 into January 2019. It was about a 35-day shutdown. And I would think that this one actually turning into a shutdown would warrant or garner more hysteria, but it really hasn't. No. I mean, I think it's logistically really tough for the people that have to work through this, but it feels pretty quiet on people love a fear headline or something to spook them, especially in the investment world. This feels pretty muted.
Yeah. And I guess the case for if a government shutdown drags out long enough, there could be potential negative impacts on the economy. And I guess that's the fear, where it's you just don't know if, the government spending is a big part of GDP. And if that dries up for a meaningful amount of time, then what's that going to do to economic growth, right? So I guess that's the angle. But I think most people understand that these government shutdowns are kind of done to score political points. In our experience in the past, workers, they get put on furlough, but then they get paid back for those wages. So maybe your TSA workers they're working because they know that they will get paid eventually, even if it's going to be a little bit delayed, and they do a very important job. So I think these things just tend to be pretty short-lived and so not super impactful.
Yeah, and also from a market standpoint, in terms of looking at investment returns through government shutdowns, there's been 10 of these since 1980. And if I look at all 10 shutdowns, the worst return through any of these 10 was a decline of 2%, and that was the shutdown in 1990. 7 of the 10 shutdowns, the S&P actually rose through.
Wow.
The most recent shutdown from December 18 to January 2019, the S&P was up to almost 10.25%. The other ones, you didn't see that much action. The 86 shutdown was pretty much slightly negative, but flat. All these other shutdowns, it's plus or minus a couple percentage points in terms of market returns. They're not the kind of sell-all, fear-inducing events that spill into the markets, which,
Yeah.
yeah.
I feel like there's two like government finance things we hear about all the time where Congress people are fighting with each other, and there's like, you know, both sides are saying that the other side is holding the country hostage, and it's the government shutdown. So that's literally like, are we funding the government? And then, but then there's also like the debt ceiling, right? And I think the debt ceiling tends to get more hysteria because theoretically, if you're a country that prints its own money, you could never default on your debt because if you owe money, you simply print more money and then you can pay it off. Of course, doing that would increase inflation and there'd be negative impacts of it, certainly. But technically, like it should be the case that the U.S. government can never default on their debt. But every time we get into the debt ceiling fight, that's what's going on.
Yeah.
Where because Congress authorizes a certain ceiling for debt that has to be raised, right? They already set the budget. So like the budget's been set. They knew that they were gonna have to spend this money, but there's also this debt ceiling that kind of acts as a negotiating ploy, pretty much a high stakes negotiating ploy. So I think that one attracts more attention because a default on US debt would be potentially catastrophic, right? If people actually believed the US wasn't going to pay its obligations. I don't think people actually believe that. But we never see, the debt ceiling get breached, right? There's always this argument. It never actually comes to that. But I think it's interesting with these government shutdowns is we get these fights regularly. Sometimes a shutdown's avoided. Sometimes a shutdown happens. And it's interesting to me that like, been there, done that, looking at the stock market returns, basically the stock market seems to yawn at it. Like it's a big nothing burger.
Is it possible, Andy, that the markets, which do a fantastic job of pricing in information and future expectations, does the market just expect a fully dysfunctional Washington, D.C. at this point?
I mean, I
Is
could
that just
not, right?
it seems
Yeah.
like, it seems like markets ignore a lot of negative news, a lot of troubling news, or a lot of disruptive news, and this is just another one of the many examples. So, um, the historical context for a government shutdown from an investment standpoint, 7 out of the 10 shutdowns since 1980 produced positive returns. I don't think I don't think it correlates strongly in any direction, meaning I don't think the reason the markets were up during those 7 out of 10 windows is because the government was shut down. I think it's just, you always hear over and over again that if you look back historically, markets are up 7 out of every 10 years or 75% of the time. There's something magic that just like most of the time the market is trending upwards and we have pullbacks along the way. And pullbacks, corrections, crashes, whatnot are not driven by political events. So,
Yeah. It's funny. We always talk about that during an election season, right? Like I think we've both been on webinars. We've both written blog posts and stuff where it's like, keep your politics separate from your investments. What goes on in Washington only has some impact. It's only one of many factors that impact stock prices. And I feel like we all understand that during election season. And then, when government is actually governmenting like it is right now, sometimes it's easy to forget that. But again, like these things happen, to your point. Those stats are, I mean, they speak for themselves, right? 4 out of
yep.
5 years, 75% of the time, whatever your number is for when the stock market goes up, you're typically better off just staying the course. And that's probably a common theme that you'll pick up if you listen to this podcast regularly.
Yeah, a boring but calming theme. But something else a little less boring, a little more exciting, and always changing is the tax code. And you pinged me last week an article from the Wall Street Journal about a tax change happening next year. And you're like, I've had several clients ping me about this in a short window of time. Have people been asking you about it? Let's address it on the show, and that's what we will do. It is the dreaded 401k catch-up contribution rolling out.
This is so niche, right? You have to be at a specific income level and a specific age for this to even be relevant to you.
Yeah.
But if it is relevant to you, it's highly relevant to you.
Right. Well, let's do a quick summary of it. As we all know, when you're saving into a qualified retirement plan, the IRS allows you, with your employer's help, to defer a certain amount of money pre-tax from your pay into a retirement plan. that number is indexed every year for inflation. For example, this year in 2025, you can defer $23,500 of your salary and bonus and other earned income into a retirement plan, which is for most people a 401k through their employer. That is if you're under the age of 50. And a while back, the IRS said, you know what? We're going to team up with Congress and we're going to come up with a way for people over the age of 50 to get a little bonus contribution into their plan to help them kind of speed up the process of saving for retirement. This is what became known as the catch-up contribution, literally implied in the name, helping people catch up with their retirement savings. So up until recently, you were able to make a meaningful catch-up contribution if you're over the age of 50. That amount is $7,500 and has been, hovering around that level for a while now, indexed up and down, obviously, over the years. But if you're over the age of 50 in 2025, for example, the 7,500 catch-up contribution plus the 23,500 standard contribution gets you to 31 grand that you can defer pre-tax into a retirement plan. I'm going to throw another wrinkle into this before I talk about the tax change for next year. But there's an additional bonus contribution if you are 60 to 63, which gets you from
So
30.
specific,
Yeah.
right? So
specific and typical with retirement legislation. Makes little to no sense, but if you're 60 to 63, you don't need to, get stuck on the $31,000 number. You can contribute a total of $34,750. And then when you turn 64, you go back down to the 31,000. So
that's the part that is crazy to me, right? It
Yeah.
stops right at
Some
age 63.
people
Nice
that are
round number.
60 to 63 apparently need a special additional few grand catch-up contribution. All of that, I guess, getting to the main point here, that historically, all of those contributions were pre-tax, meaning you were able to defer income today to some point in the future when you took distributions from these retirement accounts. So it was a nice tax perk and a big reason why people aggressively saved into their retirement plans. However, in 2022, we went through another version of the Secure Act, which made a handful of retirement changes. One of them being that starting this coming year, January 1, 2026, if your income exceeded a certain level, your catch-up contributions could not be pre-tax. They would now have to be Roth contributions. So not to make this any less confusing than it already is, starting in January of this coming year, 2026, if your prior year income was $145,000
Another
or
nice
more,
round number.
yeah, $145,000 or more, then those catch-up contributions would now have to be made on a Roth basis, meaning you would have to pay tax on those contributions before they go into the plan. But once they're in the plan, they can grow tax deferred and come out tax free. It's obvious why that change was made. They said, well, wait a minute. If you make over a certain amount of money, we don't want to wait for you to defer tax on that. We want those tax dollars now. And then, go ahead and save that money for the future, but pay the piper today, so to speak. And
Yeah.
so
I've been training my kids when they want something like milk or a snack to say, it's my milk and I want it now.
Yeah, that's the IRS.
I feel like that's what the IRS is doing here.
Yeah, that is what the IRS is doing. It is terribly confusing because now you're combining these Roth catch-up contributions starting next year with these additional 60 to 63 catch-up contribution changes from the prior year. So saving into a retirement plan should be getting easier. It's getting way more confusing. A couple points on this, just to kind of wrap this together into practical terms. The numbers for 2026 have not fully been released yet, so the income threshold, the contribution amounts, we should know those hopefully soon. But the threshold to qualify, or I'm not going to say qualify because it's a bad thing, be forced to make these catch-up contributions on a Roth basis, that 145,000 applies whether you're single or married filing joint, which stinks. So
That's the
that's,
technical term for it.
yeah, the technical term is that stinks. The second is it looks backward 1 year. So whether you
Yeah.
whether you have to make these Roth contributions next year depend on your income from this year, 2025. When you go to look at this in 2027, it'll look back 1 year to 2026. So it kind of is a rolling 1 year look back. It's per the income limit also is per employer. So if you had one employer for the whole year and you made $150,000, you have to make these Roth after-tax contributions. If you had two employers throughout the year and you split that income 75 grand between the two instead of 150 for the one, then you don't need to make the Roth contributions because neither of those employers exceeded the $150,000 limit.
How
So,
does something like that even like get codified in law, right?
well, it's
Multiple
been a mess.
employers.
So the administration of this is going to be a mess because if your 401k provider does not allow for Roth contributions, which not all of them do, even a majority, even not, even a lot of Fidelity and Vanguard, who are two huge 401k custodians, I think up until a couple of years ago, like 30 to 40% of their plans did not offer Roth
Wow.
contributions, and that's them. Imagine the smaller providers, not as much of a problem, but if your 401k plan does not offer Roth contribution, then you can't make catch-up contributions at all. So
Yeah.
that's a big knock. If you work for a smaller employer, you do the smaller custodian, being boxed out of the Roth contributions completely could be a negative. I I don't know. This is kind of, it's not a nothing burger. I think it is in terms of tax savings lost in a given year, it's something to be aware of. Will it change, or will it get delayed again? I wouldn't be surprised. These things happen all the time. They just keep kicking the can down the road and they don't end up going through with it. But it seems like this, as of today, October 6th, 2025, it's going to happen. Um, but, you know, let's try to make positive news out of something that's terribly confusing. And a little bit of an annoyance is this like a forced Roth savings that normally people wouldn't do? Like collectively, if someone has only
Yeah.
been saving in a pre-tax retirement account their whole career and now they're being forced to shift some of those dollars to Roth, the tax sting today might hurt, but those dollars compounded at, call it 7 to 10%, depending on the risk level of your portfolio over many decades. I think those Roth dollars can turn into something meaningful and maybe not today, but maybe far in the future, make you happy you did it.
Yeah. No, that was the question I was gonna have. Like, I totally get it. If your firm doesn't even offer a Roth 401k and you're totally boxed out, right? You just can't do this at all. And to use your word, that stinks. And the whole idea of this, whether you choose traditional or Roth 401k contribution, is kind of based on what your taxes are in a given year, right? So if you're a high earner, you're making a lot in taxes, you might prefer to, you know, be able to do that traditional 401k retirement plan type contribution so that you don't have to pay those taxes. You can defer them out to the future, right? It might make sense, but you might pay less in just the overall, taxes. So I get it from that angle too. But still, tax-free growth in a Roth IRA is really attractive, right? So I have not done the math on this, but I wouldn't be surprised that it comes out to the break-even amount if you assume a reasonable amount, rate of return for people who are in their 50s or 60s doing these catch-up contributions. it actually might be to their benefit to get that money in the Roth IRA long term.
Yeah, if someone
Who
can
knows?
if someone can shut their eyes and wake up, 15, 20 years from now, there's probably, certainly truth to that. I think we talk a lot about tax diversification, not overly obsessing with tax deferral alone, but thinking about what it looks like to spend down your portfolio in retirement and wanting to have in a perfect scenario, you've got some amount of pre-tax money, some amount of taxable money, some amount of Roth money. What the pie chart, so to speak, should look like is dependent on your circumstances. But I think those that build flexibility in their plan usually don't regret it, over the life
Yeah.
cycle of retirement. This might be a great way to step in that direction. Certainly, when you look at these things, you're comparing today's tax rates to what tax rates might look like in the future, and who knows, right? I mean, the
Yeah.
tax code changes. We don't know with 100% certainty if your tax rate is 35% today, that 30 years from now, it won't be somewhere near that still or higher. I mean, it's just, that's what you deal with when you make decisions about saving for the future. But it's
Art and
complicated.
science.
Yeah. The main takeaway is that, as you saw, trying to explain this in a short window of time, these contributions are the 401k contribution, sphere of confusion is building, and it's, extra catch-up contributions based on a few years, going from pre-tax to Roth, different catch-up amounts. And so it's not getting simpler, but this is something people have to be aware of that's starting in January 1 of 26 as of today.
Yeah. So we'll see what happens. By the way, did I tell you I got stung by a bee today?
You did. I heard your very long, dramatic story, and
I'm just minding my own. Have you ever been stung by a bee on the head? Like, come on. How does
no,
that
I have
happen?
not been stung by a bee on the head, but
I mean,
uh,
yeah.
this is why you
I
don't walk
won't.
by bees' nests.
Well, I mean, it's just where the bus stop is. I have to put my kid on the bus, and her fellow busmates like to provoke these bees, and I was on the receiving end of the
Better
pain
you than the
there.
kids, though,
So,
right?
yeah. Well, I think that's why they're interested in it, because one of the kids did get stung, and was crying and everything like that, and so like the kids see that as like, oh, this is dangerous. That makes
Hopefully,
it
no one
fun.
saw you cry.
Like the Russell Wilson Subway commercial.
Yeah,
But anyways, this whole experience got me to thinking, you never know when things happen.
yeah.
So my question to you, Adam, is like, when should I consider starting a trust?
A trust. If I had to come up with a list of like the most frequently asked questions from a planning perspective, the whole should I have a trust, conversation is right there at the top of the list. Trusts are the ultimate flexibility tool when it comes to estate planning. They come in an unlimited number of different flavors. That's why when people ask about specifics of trusts, and they're like, well, I don't need a trust because I don't need to give my kid money at 10 different dates in the future. I'm like, well, that's one variation of a trust, but there's essentially an unlimited number of variations you can toss into trust vehicles because they're incredibly flexible. They give you a way to control your assets from well beyond the grave and well into the future. So for a long time, the main thought with people are, trusts. Trusts are only for the ultra wealthy as a way to avoid estate tax or limit estate tax. And that still is very true. There are certain types of trust vehicles designed specifically for those who exceed the estate exemption amount, which starting next year is going to be 15 million per person. So they can certainly be used for that reason, but also they are just great legacy planning tools for that don't have an estate tax issue. So whether or not you need it, certainly with a lot of these things, it comes down to personal preference, weighing pros and cons, weighing the costs versus the benefits. I would say I'll talk through a couple reasons why people really get excited about moving forward with the trust vehicle as part of their state, and then a few reasons why people try to avoid it or they elect not to do it. And I'm going to first talk about revocable trust because there's two main avenues you can take when implementing a trust vehicle. The first is making that trust revocable, meaning it's implied in the name. You fund it now or in the future, but you can revoke the right to do that. You still have access to a large degree to the funds inside of the trust. It's still your money. You haven't given it away or punted it to some point in the future. So revocable trusts, I think, are the most common, especially with our clients, because it acts very much so like a taxable account today. It's still taxable to you, but it has way more bells and whistles in terms of instructing people what to do with your money in the event of your passing.
Right, right. So it's like, a normal brokerage account, you can set beneficiaries through a TOD, transfer on death, but that's about it, right? This can be a little bit more specific.
Right, like the proverbial joint account or individual account with the beneficiary designation, transfer on death, it stops. It kind of takes one step past your death, either to the other joint owner or to the beneficiary in the case of a TOD account, and then that's it, right? Like someone's got to decide
Mm-hmm.
what to do with the money after the second owner passes. With the trust, you can divide up the money in multiple different ways. You can dictate terms around who gets money and when. You can dictate whether income has to be paid out or it can be preserved in the trust. You can dictate, how taxes are paid in the future. You can dictate even things like what it invests in. So anything you can think, it's an open-ended recipe, essentially. You can get very creative with how you dictate what happens in the trust. And so just simply retitling taxable assets today in the name of a revocable trust allows you to have the peace of mind that if something happens to you at some point in the future, you've checked all your boxes, right? Like you've decided where that money could go and on your own terms, which is usually one of the things that get people most excited. The other variation of the trust is the irrevocable trust, which we're not going to dive too deep into today for purposes of this conversation, but that is usually the trust vehicle most heavily leaned upon for estate tax, getting money out of your estate and avoiding that very punitive 40% federal estate tax. So an irrevocable trust is implied in the name irrevocable. You're putting money out of your name into the name of this trust vehicle and saying, I'm not going to touch this again. This is for these other people at some point in the future. It's not mine. Don't tax me on it. And see you later. So that is obviously a very different set of circumstances. Typically used for those with estate tax problems. There are many wrinkles you can throw in there. There's ways to still get some money out of it for your benefit. There's all kinds of minutia we could get into, but the first decision you need to make is whether you want the trust created now or at your death, or whether you want to create it as a revocable trust or an irrevocable trust. But essentially, usually the people at various levels of net worth are excited about these because of the control level, because of the flexibility, and they just have to weigh that usually against the cost, right? When you put together a plain vanilla will with some powers of attorney, that's a cheap, easy process that doesn't require a lot of thought usually. Trust vehicles, you need to pick a trustee, you need to pick the beneficiaries, you need to decide when they get the money and how. So they're more difficult to develop and administer. And I think estate planning and estate document, writing estate documents is incredibly it's usually difficult for people to get motivated and execute on. So the tougher it gets, the longer it takes them to do it. So the
Well,
procrastination
no
factor is
one wants to
higher.
think about what
Yeah.
happens after I die, right? I get that.
No. But a revocable trust, even if you just do it, I hear all kinds of misconceptions about them, about their what it means from a tax standpoint and creditor protection. Certainly certain trusts provide creditor protection, but not usually not revocable trusts because the money's still in your name. Uh, But that, I think a lot of times the noise takes over the just very simple benefit of you've got this money, you want way more control around how it's dispersed, who gets it, when, how, and why. And it's just weighing that against the cost. So when I get asked that question, like, do I need a trust? It's not so black
That's
and
a can
white,
of
right?
worms, right?
Right,
A
because
whole
you
can
can
of
have a
worms
joint
there.
account with your husband or your wife, and if one of you passes, the other of you, the other one of you
Yeah.
now has access to that money free and clear. You probably there have intended what you wanted to have happen, which is that my death, I want my spouse to get my money, or my kids, or my grandkids, whoever it is. Um, but trust planning is really for those that want to take it a step further and say, okay, I want my spouse to get my money, but then when they pass away, I want this to happen. And I want it to happen in this window of time. So that's kind of the 40,000 foot, like, general pros and cons of like the trust conversation in general. Obviously, this gets way more granular and more specific to you with a conversation with your advisor. But the one thing I don't want to miss the forest for the trees on the conversation around probate avoidance, because
Hmm.
certainly a trust is one way to avoid probate. Certainly putting beneficiary designations on your assets is another way to avoid probate. And probate is incredibly expensive and time consuming. And when I say time consuming, I mean if you die with assets that are going to be subject to the probate process, meaning any asset that doesn't have a direct beneficiary designation or in trust, that means that the courts have to decide where that money goes. It is public information. It can be legally contested by heirs who hate each other, and can take a long time and be incredibly, incredibly expensive. So while a trust is not the only way to avoid probate across the board, it is a way for your heirs and the trustee to have the ability to access that money for your heirs and beneficiaries in a way that meets your intent without worrying about what could be a very, very long process. So that is a public service announcement to step one. You have got to have some sort, having a taxable account without beneficiary designations is something that needs to be evaluated immediately and changed to make sure that you do not subject yourself and your heirs to the probate courts. And second is a trust could be a great flexible tool to help you manage that.
Yeah, that's a great PSA. I think a lot of people think estate planning, they think I've got a will. I'm covered. It's fine. I've got a will. So why should people take the next step maybe in consideration of going, if they have a will, why do all that time and effort to get to a trust?
Well, and that's a good point because, like, it's not an either or proposition. Like, a
Hmm.
will and a trust work together because there's certain things that you want to have in a will that are not going to be in a trust that are going to dictate, to kind of smooth out the process. For example, personal tangible items like household items or valuables, things like that can be
Right.
listed in your will and administered as part of your estate, but that's not going to be listed in a trust vehicle. So a will and a trust complement one another. A will, it's a snapshot in time. It's, hey, I died on this date. Here's what I want you to do with my money and my assets. A trust lives beyond, right? It's like I said earlier, a trust is
That's
a
a
way to
great
pull strings
distinction.
from beyond the grave.
Right.
A will is a balance sheet. A trust is like a future looking cash flow statement. So a will only helps you for so long. It's still very
Hmm.
important, but a trust allows you to, look far into the future and have that peace of mind that, hey, I've accumulated a lot of resources. I want to make sure this is going exactly where I want it to go. And again, not black and white. If you're a married couple with, a couple kids, and you're like, hey, listen, when we die, we just want our assets to go to each other. And then when the other one passes, that whatever remains can go to our children. If there's not family complications, if there's a very clear path to, over the next generation or so where you want your money to go, having, a really great will, beneficiary designations on your accounts, and powers of attorney can get you from point A to point B, probably without a lot of hassle or cost, and you could probably be fine. And that's why I say it's not, you have to do this, you have to do that. A trust is just a way to layer on top of all of that some contingencies, some more specifics around, the order of events and the timeline.
We were putting out Halloween decorations this weekend, and we put out like mummies and, these like, undead creatures, right? So that's essentially what you're becoming with a trust, right? You may have passed, but you're still able to pull those strings from the grave.
Yeah, exactly. That's a Halloween themed way to describe trust documents. And I think it's like, again, a lot of this is not, these are tools in your toolbox, but I always, in the age of social media and online articles, I always see these black and white headlines like, you do need a trust, you don't need a trust, or these very definitive statements that are not taking individual circumstances into account. So it should be a tool in your toolbox and a great thing to discuss with your advisor.
It's never black and white, is it?
No.
As much as we want it to be, it never, almost nothing. I mean, I'm sure there's some examples maybe that are very black and white, but like almost none of the stuff is black and white. It's so specific to your situation.
Well,
I know that can sound like a cop-out.
Yeah, well, what's we did behavioral finance last episode, and you talked about how we're evolved over millions of years and our brains are wired for certainty and fight or flight and all that.
Yeah.
Psychology, brainwashing stuff you tossed at me.
Right.
That all boils into it. Like, we want the certainty. We want to know that, like, this is the path. This is it. There's not an alternative. But
there's a term for when like actions are differing from like feelings. It's called cognitive dissonance, and it's really uncomfortable, right?
Yeah.
That's how a lot of the stuff is.
Sure. Yeah. All good.
But we don't need to go back into the behavioral, psychology episode.
We will not.
Did that last time.
I'm stopping you before you're able to do that. So we've been getting really great questions. So thank you all. Email for questions is longstoryshort@Bernie, BURNEY.com.
Keep them coming.
Thank you very much.
This podcast featured Adam Newman and Amy Pratt of Bernie Wealth Management, which is a division of the Bernie Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long Story Short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational, educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who's familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Bernie Company is an SEC-registered investment advisor. Registration with the SEC or any state securities authority does not apply to the Bernie Company or any of its principals or employees, possesses a particular level of skill or training in the investment advisory business or any other business. Bernie Company does not provide legal, tax, or accounting advice, but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.